Welcome to Alpha Recap. Today we're breaking down the market action after the close. And as always, if you have questions, you can reach us at stockalpha.ai. Tom, good to have you back.
Thanks for having me. Lots to unpack from the session.
Quick headline to kick us off. The S&P finished the day down about 0.5%. The tech-heavy NASDAQ 100 was down about 1.25%. And small caps actually finished up about 0.5%. So rotation rather than a broad sell-off. What was your read?
Right. This felt like profit-taking in large cap growth and fresh buying in cyclical, domestically exposed names. I mean, when you step back and look at this, you're seeing multiple compression in the most rate-sensitive names, while investors rotated into materials, energy, and parts of industrials.
So what really stands out here is that divergence. Walk me through why tech led the downside and small caps outperformed.
Two main forces. First, valuation anxiety, particularly around memory and semiconductor supply chains. Second, headlines pushed investors to focus more on capital allocation and deals rather than pure top-line growth. So big growth names that had stretched multiples got clipped, while stocks tied to domestic demand picked up interest.
That makes sense. You mentioned semiconductors and memory. Were people specifically calling out margin pressure?
Yes. Memory pain, supply dynamics. Those phrases were used. Traders worried margins could compress, and when a sector is priced for perfection, any hint of margin pressure triggers faster moves. Not a great day for chip-linked names. Right.
Let's hit the sector tape. Which areas were the brightest spots?
Materials and mining stood out. Catch-up buying after supply stories and commodity stabilization. Energy also had momentum, helped by seasonality in demand and some M&A optimism in midstream. Industrials rallied on better order commentary, and parts of financials, especially regional banks and specialty lenders, held up because rate differentials stayed attractive for net interest margins.
And where did investors get more cautious?
Technology was the weakest sector overall. Large cap software and platform names saw multiple compression. There was also selective caution in real estate. Buyers were picky about cap rates and credit quality. Healthcare and biotech were mixed. Device names with steady revenue did okay, while some biotech stocks moved on company-specific news.
Yeah, absolutely.
Honestly, I was a bit surprised by the breadth and materials. People jumped in quickly when commodity chatter turned constructive.
Let's talk about specific corporate stories. Marvell made headlines today. What happened there?
Marvell announced a big optics deal, a transaction valued at $5.5 billion. M&A like that can be positive long-term, but in the short run, investors debated integration risk and whether consolidation would actually boost margins the way management suggested.
Hold on, say that again?
The deal was about $5.5 billion, and the market reacted to both the upside of scale and the near-term integration questions. That tug of war helped drive some of the stock's movement.
Avnet was called out as a small cap favorite after earnings commentary. Why did traders like it today?
Avnet's fourth quarter conversation about supply chain normalization resonated with traders. In a tape where small caps were getting bought, distributors and industrial suppliers that signaled improving order flow tended to outperform.
What about some of the other names? Linde, Dexcom, the biotech filings?
Linde saw institutional trimming, profit-taking in defensive industrial gas names. Dexcom got a fresh vote of confidence from a big growth fund, which highlighted interest in durable medtech franchises. And biotech volatility was driven by 8Ks and company-specific developments. Revolution Medicines and BioCryst moved on filings that altered near-term narratives.
Got it. We keep hearing that the Fed's messaging mattered today. How did the economic backdrop play into this rotation?
The week's data mix painted steady activity, not runaway growth. Fed officials reiterated data dependence, and markets concluded rate cuts remained unlikely in the near term. That higher-for-longer expectation punishes long-duration growth and helps cyclicals and financials that benefit from higher nominal rates.
So the Fed's optionality created a two-speed market.
Exactly. Stocks priced for perfection in a lower-rate world got clipped, while names tied to nominal GDP, commodities, or the yield curve caught bids.
Short reaction.
Yeah, that tracks.
Let's shift to technicals. What were technicians looking at after the close?
Technicians pointed out that the NASDAQ 100's drop breached a nearby congestion band for some traders, which triggered stop losses and short-term adjustments. Small cap strength was notable. Advancing issues and new highs inside that complex outnumbered decliners, suggesting buyers were adding cyclicals on dips.
And how do traders interpret these divergence days?
Divergence days often lead to consolidation as capital rotates. People will be watching breadth indicators, put-to-call skew, and which sectors lead, to see if this was transient profit-taking or the start of a broader regime change.
Historically, have we seen this kind of rotation before?
Yes, similar patterns showed up in 2018 through 2019 and in late 2023 into early 2024. In those periods, tech took hits, value and cyclicals got a re-rating, and outcomes depended on macro surprises and Fed moves. The difference today is there wasn't a single big catalyst forcing direction, more a collection of headlines and flow.
Which macro items should listeners keep an eye on tomorrow?
Watch any manufacturing and services data, regional Fed commentary, and scheduled Fed speakers. Those can tilt expectations on growth and inflation. Also, earnings and 8Ks will continue to create stock-specific volatility.
Practical question for investors. Given this environment, what positioning did you think made sense?
Discipline and diversification. Active stock selection mattered today. Growth investors needed to brace for more volatility in high multiple names, while value and cyclicals should monitor macro confirmation that earnings and cash flows support a sustained re-rating.
Right. And the other thing is, investors should watch technical levels too.
Exactly. If small cap leadership persists, that's constructive for cyclicals. If the S&P can't hold support, you'd see more defensive positioning. So it was important to keep an eye on both fundamentals and tape structure.
Short reactions. Yeah, that tracks.
A couple of quick takeaways before we close. 1. Today was rotation, not ruin. The indices diverged rather than everyone heading for the exits. 2. Fed data dependence is keeping a lid on clear consensus, which favors selective trading. 3. Stock selection mattered more than index bets. Company news and filings moved individual names.
Great. To summarize, S&P finished down about 0.5%, NASDAQ 100 down about 1.25%, and small caps up about 0.5%. Materials, energy, and industrials caught a bid. Technology saw multiple compression, and the Fed's stance fueled a two-speed market.
Yep, expect more differentiated trading in the near term, rather than a synchronized rally or sell-off.
Thanks, Tom. Any final thoughts?
Stay tuned to earnings and data, and be ready to adjust positions as the story evolves. Active management paid off today.
If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai. Thanks for listening to Alpha Recap. We'll see you after the next close.